corporate bond market works right now. We've got the taxpayers right here. They give their money to the state government. The state governments take that money and they put it into the public pension funds that, remember, need a 7% rate of return to meet their obligations to those original taxpayers. They used to get that from the federal government, the treasury bonds, but because the Federal Reserve dropped interest rates so low, so long, remember ZIRP, zero interest rate policy, they can no longer get the return that they need. So they went over here to the corporate bond market because they offered these pension funds a higher yield. So that money from the taxpayer goes to the fund, goes into the bond market, and then the bond market sells, or an individual corporation, sells the fund the bond. That taxpayer money comes into the corporation, who put their bond into the market. That's the same bond that went over here to the fund. The corporation takes that money that they borrowed, goes into the stock market, and buys back their shares. Those shares go to the corporation, which goes onto their balance sheet. So their balance sheet expands because now they have more equity. That's what their shares are, their equity in the corporation, but they also have more debt. We start to see a little bit of a problem here because the cash flows of these corporations as a percentage of their balance sheet starts to get smaller. When that happens, the ratings agencies see that and they said, boy, we don't like that. That's not looking good. So we're going to take that corporation and we're going to downgrade its debt. So in the corporate debt market, you've got different grades of debt. The best is AAA, and then everything in between is from BBB, BBB, and up. And this is what they call investment grade debt. So everything above this blue line is investment grade. That's the majority of the corporate debt market. And down here below that, you've got junk bonds. And it's kind of a weird name, but it's basically high yield bonds. These are bonds that are more risky, so they give the buyer of that debt a higher rate of return. But this is not considered investment grade. So the public pension funds cannot buy, and a lot of other institutions cannot buy junk debt. They have to buy investment grade debt. And what's happened is so much money has come into the corporate bond market to buy all this debt, and the balance sheets of those corporations have gotten so big with so much debt that they're taking on, so much cheap debt, that the ratings agencies have downgraded a lot of their debt. So back in the 1950s and the 60s, as an example, this circle right here would have been mostly AAA debt. But now the majority of this corporate bond market is rated BBB, just one step above junk. Step number 2, let's think about some of the problems that could ignite the corporate bond market time bomb. First and foremost, corporate debt is at its highest level of all time relative to GDP. And this isn't a phenomenon that's exclusive to the United States, it's actually worldwide. Number 2, baby boomers are starting to retire. This is huge. We've all heard this in the news, but it's a really big deal. First and foremost, because they're going to start pulling out a lot of their money from these pensions. So the pension funds will have higher payouts, they'll have higher obligations, and they'll take a lot of this money out of the stock market because they need that money to live on in their retirement. Additionally, naturally, when we retire, we spend a lot less money. So if there's less money being spent into the economy, that's a lot less tax revenue that the state is able to collect. And, of course, once again, going back to the Federal Reserve, we've got zero interest rate policy for so long, for that 10 or 12 years, that the baby boomers that are retiring now are actually saving even more money because they weren't able to get that return they were expecting on their savings because interest rates were so low. So since they have less money to spend, they're going to spend less money. Number 3 is the business cycle, or the next recession. As we know, credit runs in cycles. It expands and it contracts. So when we have the next recession and credit starts to freeze up, that's going to affect the cash flow of these corporations. They know that their cash flows are cyclical, so they're going to get really nervous about that. So when cash flows start to decrease, naturally, the stock market is going to see that, and that's going to go down. But what we have here, since all these corporations have bought so much of their shares back, and almost 100% of the stock market going up since 2010 has been a result of those corporate buybacks, the corporations are going to look at their balance sheet. They're going to see that they have less cash flow coming in. The less cash flow they have coming in, the harder it is for them to service the amount of debt that they've put onto their balance sheet. So they start borrowing less from the corporate bond market. They start buying back fewer of their shares, if not stop altogether. And this puts further downward pressure on the stock market. You see this kind of negative feedback loop that starts to originate. Step number 3, the corporate bond market endgame, how this whole thing could collapse. It starts with our main trigger, which would be the recession or the business cycle. That would lower cash flow, like we talked about in step number 2. It'd lower the cash flow going to the corporations, but it would also lower the cash flows going into the state governments, because that recession means lower tax receipts. So if there's less tax money going into the state governments, that's less tax money going into the pension funds. That means the pension funds can't buy as much corporate debt. Because there's less demand for that corporate debt, it'll naturally make the rates start to increase. At the same time, this dynamic is putting upward pressure on the interest rates in the BBB bond market. We've got those cash flows that are decreasing to the corporations. So the ratings agencies see this. They see the shrinking cash flows relative to the size of their balance sheet, and they start to downgrade that corporate debt. But remember, if this corporate debt gets downgraded into high yield or junk status, the majority of the people that buy this, or the majority of the entities that buy this, can no longer buy it. So this blue line would go from here all the way up to here. So you would have 95% of the entire corporate bond market go into junk status. And right now we've got 3.5 trillion in BBB, 1 trillion in junk or high yield. So what that tells us is that we only have about $1 trillion worth of buyers for a market which would now be 4.5 trillion. In other words, there would be no buyers for the corporate bond market. There wouldn't be a bid. All the buyers that were in here would go to the exit because they can't even buy it anymore. That would take the interest rates that these corporations borrow at, those interest rates would go to the moon. If interest rates go to the moon, that means the borrowing costs for the corporations increase. That lowers their corporate profits. At the same time, when the stock market's already going down because there's less cash flow coming into the corporations because we're in recession or the business cycle has turned. Joe Public sees the stock market going down. He wants no part of this at all because he remembers the last time when this happened in 2008 and 9. Also, the majority of the people with money in the market are the older demographic, the baby boomers that are retiring, that are pulling their money out regardless. And because the borrowing costs of the corporations have skyrocketed, that means that there's no more corporate buybacks, which we know was the main catalyst to the market going up in the first place. What that means is there's no more buyers left in the stock market. There's no bid at any price. And there's no bid in the corporate bond market. And to add insult to injury, we've got this negative feedback loop that's happening at the same time where higher rates in the corporate bond market mean lower stocks, and lower stocks mean higher rates in the corporate bond market. Oh, but wait, there is more. Let's not forget about the mountain of debt that the corporations have on their balance sheet. And this isn't 30-year fixed rate debt. This is debt that they have to constantly roll over for new debt. So they've got all this old debt on their balance sheet, and they have to pay off that debt with new debt from the market because they don't have enough in their cash flow to pay off all this debt when it comes due. So while all this chaos is going on in the market, these corporations are going to have to go back in and try to refinance this debt. Good luck. They're not going to be able to do it. And that's going to mean that a ton of these massive corporations are going to be insolvent very, very quickly. And the pension funds that are already in dire straits will most likely go bust. The state governments go bust because of lack of tax revenue coming in. And this freezes the credit markets, which tanks housing. You can see why I think the next recession that we have will be far worse than 2009, and it'll all stem from the corporate bond market. I want to give a special thanks to Real Vision. A lot of these ideas and concepts came from videos of theirs that I personally watched. We'll put links below. And if you guys want more information just like this, check out this content right here, and I will see you on the next video.